Hey guys, welcome back to the show. Today, we're diving deep into a protocol that straddles two very hot narratives right now, stablecoins and leverage trading. So, if that sounds good to you, you know exactly what to do. Hit the comments, like, subscribe, and let's get into the video. Hey guys, I'm Alessandro. Remember, nothing I say is financial advice. I'm not a financial advisor. Everything's for education and entertainment purposes only, and it is not intended for a UK audience. Full disclaimer in the description below. So the protocol we're talking about today is called FX protocol. Now, as I said, it straddles two very hot narratives, stables and leverage trading. The actual mechanisms behind how this protocol works are pretty hard to wrap your head around initially, and you definitely need to spend some time sort of like looking at the mechanics to fully understand it. I'm gonna start with a broad overview. I'm going to go relatively deep, but don't worry if it's confusing. The actual what's underneath the hood is not as important as understanding why they kind of like stand out, right? So the first thing they have is a stablecoin. It's called FXUSD. Nothing special about the stablecoin. Pretty standard over collateralized stablecoin. You can mint it with USDT, USDC, ETH, wrap Bitcoin. Pretty standard, like very secure DeFi assets. You can mint this stablecoin. It's over collateralized. That's the stablecoin. Pretty standard. The way they use this stablecoin, or the yield that they get from this stablecoin, essentially is created from this other part of the protocol, the leveraged trading part of the protocol. And the leverage part of the protocol stands out against other leverage platforms because it is offering almost zero borrowing costs, so almost zero funding for the position to be held open. Now, if you are a short-term trader and you hold trades open for an hour, maybe a day, maybe a couple of days, these funding rates, yes, they are important. Yes, it makes a difference, but it doesn't make much difference. If, however, you want to hold a position open for a month, 6 months, maybe a year, suddenly borrowing costs can actually make the position impossible to hold at certain leverage ratios. If, for example, if you don't know, let me just dive in real quick. If you don't know what funding costs are, let me briefly outline what they are quickly. Any sort of like perp decks like Hyperliquid, Lighter, Bybit, Binance, whatever, right? They all have this thing here called the funding. Now the funding is the amount that the one side pays the other side. Oftentimes, it's if you want to take a long position, i.e. buy, you need to pay the short side. And actually the platform don't really make any money from funding. Funding is peer-to-peer. That means it is anyone who's trading, whether they're going long, like buying, or going short/selling on a perps trap platform, they're paying the other side that has less people on it. So if more people want to go long than short, the people on the more popular side, the longs in this case, must pay the shorts to keep the position open. Vice versa can be true. If more people want to be short than long, the shorts must pay the longs. Sometimes you see this annualized figure here. This figure here generally is negative. Generally in crypto, funding is positive, and generally in crypto, when things get overheated, funding is very positive. It can be, you can see these figures as 100% annualized, 200% annualized. That happens, right? Generally, around about 10% is sort of the going rate. Sometimes it's a little bit less, sometimes it's a little bit more. But the going rate right now, it's 10.9% on Hyperliquid here. It's pretty standard, really. Now, what these guys are offering is a way of borrowing, taking out a leverage position, and not paying borrowing costs. The way they do that is super clever. Okay, I'm just going to go into how they do that real quick because it is super smart. This is confusing. Don't worry, we're not going to go into this too much, but this is sort of their way of describing it. But I'm going to describe it much simpler just using this, okay, how the protocol works. Thinking about this in terms of dollar value is much simpler to understand. So Let's say I want to take a $5,000 position. I want to borrow $4,000 and deposit $1,000. So I'll say that again. I want a $5,000 position. I'm going to deposit $1,000 and borrow $4,000. Total position is 5,000. I have 20% of the 5,000 is my money. 80% of the 5,000 is borrowed. The way this protocol works is it ties into a it's incredibly an incredible thing that Aave created called flash loans. What flash loans allow you to do is in one transaction, and it has to be one transaction, you can borrow an amount with no collateral. You can do something with it. Maybe there's an arbitrage opportunity or something. You can repay the loan. You could capture the profit all in one transaction. And if it doesn't happen in one transaction, it can't happen because then obviously the protocol that's lending the money would be insolvent. You can't just loan $10,000 inside one transaction if you're not going to get $10,000 back. The only way you can access flash loans generally is by using protocols at the sort of like on the back end. Protocols don't offer this on the front end. You have to plug into the protocol via an API or essentially like use the actual hard code of the protocol to be able to use it. FX protocol are allowing you to access flash loans on the front end of their protocol. So $5,000 position. Remember, we put in $1,000, we're borrowing $4,000. What the protocol then does, it takes out a flash loan for the $4,000, it buys a yield-bearing asset, generally it's ETH, right? So it buys staked ETH. So now, with the $5,000 you put in, it's bought $5,000 worth of staked ETH. So there's a $5,000 staked ETH position. It still needs to repay the $4,000 that you took. So it takes a loan against the staked ETH. The $4,000 are repaid. So in one transaction, you deposited $1,000, you borrowed $4,000, you bought $5,000 worth of ETH. 5,000 equals 5,000. You borrowed $4,000 against the $5,000 position. You've now repaid the loan, and what you have here is a $5,000 ETH position against $1,000 of collateral. So, super clever way of increasing leverage or generating leverage. And of course, because the loan is paid off, there are not actually any borrowing costs. So they have created this method of creating a leverage position without borrowing costs. Of course, the platform has fees, and this is where the platform makes money. The fees of the platform are about 0.3% per transaction, right? So when you open a position and when you close a position, which is quite a lot when you think about it. It means that this platform is only really for people who want to take out, as I said, this is where the benefit really comes in, longer time horizon leverage positions. I'm going to go through this example from this guy here. And these guys also have it's called a liquidation break. So not only do you pay no borrowing costs when you use the platform, they also have a liquidation break which prevents you getting liquidated as easily. Now 100% positions will be liquidated because the protocol needs to remain solvent, and fees are charged on liquidations. Again, these fees go back to holders of the token and holders of the FXN token and holders of the stablecoin that generates yield, right? Both those tokens generate revenue from the protocol liquidating people. So it's still in the protocol's best interest to liquidate. It just tries its best to give people a chance. So this guy, he took out a 3.2 levered position on $500 of collateral to gain $1,700 of exposure. On a normal perp DEX, this would mean that if price comes down by just under 30%, his entire position is going to be liquidated. Now, price action did come down that quantity, but the liquidation break mechanism was applied, and what this ended up meaning was even at the position that he should have been liquidated, he still held about $287 worth of the position open, which of course is still a big loss. He still lost 47%, but he didn't lose 100%, right? The other thing is that he held this position for 86 days, which means that he would have paid essentially a year's worth of funding on the position. So whatever the funding was, let's say it was 10%, he had a $1,700 position, right? $1,700. So he was borrowing $1,200 in this case. He would have had to pay $120 in borrowing costs. He was only left with $287, right, in the end. So very likely the funding costs would have liquidated him over anything else as well, or he would really struggle to hold the position open if he was paying borrowing costs. So in this case, the protocol with no borrowing cost, well, with low borrowing costs, i.e. just open and close fees, and the liquidation break that sort of like applied to the mechanism to give people a chance to stay in the trade, allowed him to hold open a position that otherwise he should have lost. So kind of cool. Now the reason this protocol came up, I noticed it actually, is because they right now, obviously this Circle IPO thing has created like a real big appetite for stablecoin plays, and it's sort of like, so Circle dropped this week on Thursday, and they dropped at like $39, ran straight up to, I think they traded at $115 yesterday or so. So like clean, like 2.5, 3x off the bat for a stock is just crazy. It does show how much appetite there is for stablecoin exposure. And these guys have that kind of stablecoin narrative, right? They're tied, they have the stablecoin that is generating yield from the protocol. And right now the yearly fees for the entire protocol are like $5.7 million, and the market cap is only $4.5 million. Now I put this in red, right, because the FDV is much, much, much higher. They've only got like 6%, 7% of their total supply circulating right now, which is not very good really, because it means that there's a bunch of pressure that's going to come from the token unlocks eventually. But right now, they're obviously trading at a real low market cap to yearly fees ratio. So as those yearly fees are generated, a portion of those fees is given to FXN stakers, bringing value back to token holders. It's not quite as good as just buying back the token. Buying back the token, for sure, is much better from a market dynamic perspective. It tends to do better for token price. But this is why it stood out that they're right now with the market cap to the FDV. It's probably one of the best ratios I've seen in the sort of stablecoin narrative, right? This is what we're getting with Maker. Maker's pretty great as well, but you know, I know Maker are almost fully diluted, which makes this even more impressive. But still, these guys right now, for their market cap, definitely in a good position. And the token release schedule is really slow actually. So these are their tokenomics. These guys have got a 48-year token release, which is pretty long. So over the next few years, like the next unlock is in September this year, the unlock after that is in September the next year, they'll only be at about 30-ish% circulating at that point. So, you know, even though this number here is much, much higher than this number here, the market cap is only going to be probably like 3 or 4x higher than this if token price stays the same over the next couple of years with the unlocks that are coming. So not too dramatic from that perspective. Okay, now why do it stood out because the yearly fees relative to the market cap right now pretty low. And what I often see, right, this is an exchange called Faro Exchange. What you often see is when TVL increases, token price tends to follow, right? The metrics the price action tends to follow fundamentals when fundamentals increase. So this exchange, massive increase in TVL, eventually token price caught up. The same thing happens here, right, with Athena. Ignore this because it's like initial drop. Ignore that. This is the token price down here. TVL sort of comes down. TVL goes up. Oh, token price comes up. TVL starts trending down. Token price starts trending down. TVL starts ticking up. Athena not quite caught up yet. Might be something to look out for. This is hyperliquid. Token price. TVL trending up. Token price kind of following. TVL coming down, token price following, TVL trending up, token price tends to follow. And this is 𝗏𝗏𝗏𝗏. Again, ignore this sort of first TGE event because these were big protocols. So when they TGE, they tend to launch like super high valuations, low float. takes a little bit of time for the market to sort of get to a reasonable valuation. But you can see here, as TVL drops, token price is going down, suddenly TVL begins to climb, token price tends to catch up, right? So the same thing is happening right now with FX protocol. Again, ignore the sort of first few months because it's always different at the start of a protocol. But here we see TVL coming down here, token price trending downwards. Suddenly TVL rallies, and now we're getting this sort of like equal uptick from the protocol. So they're sitting at $114 million in TVL right now. It's actually a little bit higher than that if you go to their website, because this is just they include TVL from the whole sort of like ecosystem. I'll show you what the whole ecosystem looks like here. So right now across the whole ecosystem, they got $188 million in TVL. $103 million is held as collateral against the stablecoin. The stablecoin's got a market cap of 58 mil. Just want to show you that quickly as well. This is the stablecoin market cap over the last, well, since like April. You can see like really aggressively ticking up, right? So what does that mean? It means more people are minting the stablecoin. More people are taking that stablecoin and earning yield on it in their platform. Their platform has a few ways to earn yield on the stablecoin. There's a curve pair here. So there's a curve pool where USDC and FXUSD are held. This curve pool keeps the price of FXUSD stable to $1. It's basically pegged to USDC. If, however, USDC loses its peg, the mechanisms behind the peg are dropped and it doesn't try and hold the peg to USDC. There are some pretty like deep mechanics as to how it holds its metrics tied to USDC, but fundamentally it works just by, if the price isn't $1, then they burn one way and they mint the other way. So it holds its peg. And obviously really the way it holds its peg is it's over collateralized with all the DeFi deposits. So as I said, you can mint it with USDT, USDC, wrapped Bitcoin, staked ETH, etc. So TVL going up, the actual platforms, dollar, USD, US dollar, yeah, that stablecoin is trending up as well. And what that means is that the protocol is getting more and more liquid over time as its fees are increasing, as its TVL as more people are using the platform, right? So something I think it just kind of stood out to me recently, definitely something to look out for. And as I said, just comparing it to other sort of stablecoin plays, in terms of its market cap right now, looks like it's something that's very interesting. And with all these, with the sort of stablecoin narrative that's going on right now, definitely something interesting. If anything else, like for me, I haven't bought this token or anything yet, but it's definitely a protocol that I will be using for those longer term swing trades, right? So if I want to take out a position on something like ETH, for sure, if I'm going to be using leverage and I've got like a 2-month, 3-month time horizon or more, this is where I would be probably playing the trading. And also, this does offer a very interesting arbing opportunity. So if you didn't know what a basis trade is when you buy spot, so you buy the token, whatever it is, and then you also do the opposite in the future. So you buy spot and then you short the futures, because as I said, there's that funding rate, right? So you can earn whatever that funding rate is because you're delta neutral and you can earn the funding rate. This provides a very interesting way to leverage a funding rate, because normally you have to buy spot, right? In this case, you could take out 2x leverage or 3x leverage, let's say, and then you can, because there's no funding costs on the long side, you can then also short with leverage you could also go on the short side with leverage and earn that basis trade as well. So I think as the protocol gets more and more users, there will be people who are like, and obviously more users, more fees, etc. There will be users that come in and basis trade from this with leverage, which is just like a very interesting dynamic that you can't really do anywhere else, because the nature of these flash loans allow for funding free leverage. So pretty interesting, I think. Okay guys, that covers the video. If you've got any questions, if you have any desires, anything you want me to cover in future episodes, please let me know. As I said, I'm bringing you these videos once a week. Hopefully in the future, I'm going to be bringing you these videos more frequently as more channel slots open. Also going to be bringing you some live videos as well, so make sure you tune in for those. Otherwise, if you enjoyed the video, please like the video, and yeah, I will see you in the next one. Thank you ever so much for watching.